Gina Martin Adams. October was a bear killer for stocks. S&P is back in the green. So should investors stick with U.S. stocks through the year end?
I think so. The seasonality, first of all, favors stocks into the end of the year. But also, this earnings season is probably the worst of the worst for this cycle. It looks to us like oil prices are stabilizing, and that's been the predominant reason why stocks have really struggled this year. So as long as oil is stabilizing, earnings will probably get a bit better into next year, and you don't want to fade or work against that earnings recovery. So we're still pretty positive on stocks.
All right. Are you positive on healthcare? Because healthcare was a huge leader for the first half of the year, but in the last 3 months, it really has come down. A lot of worries about Pfizer inverting and Valiant as well. Do you want to stick with healthcare?
We actually just recently downgraded healthcare to market weight. After 4 years at overweight, this was our biggest position, our biggest recommendation. But what we see going into next year is tougher comparisons. Earnings growth rates will slow, and the policy environment starts to come to the center of the discussion again for healthcare. So we think a market weight position on healthcare is a better way to go. Just hold the healthcare stocks, but don't necessarily sell them or buy them aggressively.
All right, and we're heading into the shopping season. People are going to be buying their holiday gifts. Do you want to buy consumer discretionary stocks now?
Yes, we are overweight discretionary and technology. These are our two favorite areas of the market for a number of reasons. These are the areas that have the fastest revenue growth prospects going into next year. They also see fairly reasonable margin expansion into next year. The discretionary companies are sort of the center of attention right now in the index, and we think that's going to continue to be the case into 2016.
All right, you mentioned technology. I want to talk about financials because a lot of people say you can't have a market move out without financial leadership. We had mixed earnings from the financials in the third quarter earnings season. What do you do with them?
I'm still underweight financials. We have been all year. We think that financials are over-owned, and there's a little bit of too high expectations with respect to financial sector earnings. We're seeing that play out through the earnings season now. The yield curve is flattening, quite frankly, and when the yield curve is flattening, you want to be fairly cautious toward financials. So we're going to stick with our fairly cautious view. But I don't think that's enough to fade the broad market.
All right, and then finally, industrials really got hit by the stronger dollar during the third quarter. Heard that from another number of companies that were reporting. If the Fed doesn't indeed raise rates in December, that delta is going to get wider.
Right.
So how worried are you about a stronger dollar really undermining this rally?
I think with industrials specifically, it's really a tale of two worlds. There are some industrials that benefit from a dollar rally and some industrials that obviously the dollar hurts. So it really is a matter of picking your spots very carefully. The dollar, in our view, is in a multi-year bull trend. It's going to remain somewhat of a problem. It's not as big a problem if it doesn't rise so rapidly. If the dollar rises in a more normalized pace, not so bad. And that's our view for 2016. So just pick your spots carefully. The dollar will become less and less of a problem as long as it moves in a slow pace.
All right, well, thanks a lot, Gina.
Sure thing. Thank you.
And thank you for watching The Street.